Welcome back. This afternoon, you're listening to the Todd Laborowitz Show, Real Estate Radio on Salem Broadcast Network, WRC 1260 AM. I'm your host, Todd Laborowitz, and we're speaking with Mike Royal, who's a wholesale lender to Topaz Mortgage. And in the studio with us as well is Jim Musgrave from Research Financial Strategies, because Mike and I, we talk a language that not a lot of people are going to understand. So Jim's going to be the translator and start asking the questions if we kind of like catch you off guard. Mike, let's try to explain to the audience. We have construction loans. It's if you buy a piece of land, you put the foundation, you build it up, and then you got to basically have a set loan. So we have a construction loan, you have a construction to perm loan, and then you got those tear downs, construction, and then people have to refinance to have a 30-year fixed mortgage. Can you explain it like we're like a 10-year-old?
Yeah, basically, if somebody does identify a lot or a home that they even want to level to the ground and then rebuild, they can go out and through a Topaz or another company, go out and get a construction loan. Those loans typically have a term for 6 to 12 months, are interest-only payments. And when the house is fully constructed, they need to go find what we call a permanent loan, which is your traditional mortgage loan, to pay off that construction loan and start the life of what we'll call the permanent mortgage.
Okay. So to get into today's economy, because after 2008, the construction loans disappeared. The construction to perm loans disappeared. They're slowly coming back into play. But what you're seeing a lot of is someone like tearing down a house, getting a construction loan, or someone going out and getting a construction loan, and then they have to pay off that construction loan. And that's what we're discussing today.
That's right. They're typically working with a custom home builder who's building one home at a time. So they need this construction loan to pay what we'll call the draws to that builder as they make progress through the construction phase of the home build.
Okay. Jim, I just want to do a temperature check with you. How we doing?
This is good. So what I've learned so far is that you have a construction loan that's basically interest only. Then I guess once you go through closing, then you actually find a real loan that basically starts off at that point.
Right, and that would be your traditional loan. We talk about 30-year fix. Some
Right.
people like the adjustable options, but that's exactly right, Jim.
Okay, I think we're all on the same page.
Okay. And I do want to explain there is a difference between the construction loans and hard money lending.
Yeah, can you explain that to me?
If you go to a bank, they're highly regulated, and you're going to get money, and you're going to get disclosures, and everything's going to be explained to you properly.
And you have to put up collateral, correct?
You do. So that is the difference between a bank loan and a hard money loan. Mm-hmm. The bank loan, of course, is collateralized by the property.
But the bank is more interested in you paying them back and getting approved. The hard money lender is more interested in making 15% interest, 5 points, or saying, I can finish a job and sell that property for double. Mm-hmm. Their interest is for you to mess up.
Okay.
Is that safe to say?
Yeah, I would say that's accurate.
Okay. So you want to know the difference, who you're going to. You just don't go to anybody on the phone.
Where do you find a hard...
That's a whole nother topic.
Okay.
For a whole nother conversation. We can have that. Okay. Because we do have a specialist coming on the show as a partner.
This is something I'm completely unfamiliar with.
Oh, that's a whole nother subject.
All right.
But for the difference is, we're talking today about construction loans. Someone goes in, gets a construction loan from a valid mortgage broker, lender, or bank. That's highly regulated. That's how I see the difference. One's the Wild Wild West. That's hard money. And then you got the regulations. So, Mike, you have a program. People are getting stuck. They need to they got to refinance and pay off that construction loan.
That's right.
That's what you're here today to explain.
Right. And one of the interesting things about how those work, or how our company works on the payoff of a construction loan, is, let's just use an example. Somebody identifies a lot. They purchase a lot for $400,000. They contract with a builder. The build costs $450,000. So their acquisition cost of that home is $850,000. Now, when a wholesale lender goes in, or us at some point, to pay off that construction loan, we're going to use the new appraised value, which generally is an advantage. So in other words, they're in for $850,000. If the appraiser goes out and, based on comparable sales in that neighborhood, recent sales, they identify that as completed property is worth $925, we'll use that value as the basis for what we can lend. and also the pricing on the loan. So the loan to value ratio, which I'm sure you've talked about some on this show, is going to be lower, which has two impacts that I can think of off the top of my head. One, the rate could typically be more favorable. And two, the credit score guidelines are typically a little more liberal as the loan to value ratio is lower.
And monthly mortgage insurance.
Absolutely. Could take you out of that MI category.
Wow. So in Montgomery County and areas in the Washington, D.C. metropolitan area, there's not a lot of land left.
That's right.
There's a lot of teardowns. And it's getting really hot now in certain areas. Like, let's just tear it down, construction, get it up. What are you seeing out there?
Well, actually, I was in a local neighborhood here in Bethesda yesterday, and it seemed like every other home on the streets I was driving through was a tear down and rebuild. The homes in these areas close into D.C. Were typically built in the late 40s, early 50s, so people are renewing these.
And as far as people getting the construction loan, they got to have something lined up to refinance out.
That's right. They do need to do that. Typically, the construction lender will want to see some sort of a pre-approval from a permanent lender to know that once the construction is completed, it gets paid off quickly.
But what I'm hearing you say, with your being a wholesale lender that you provide to your brokers like us at Topaz Mortgage, we can get a client and go off the actual appraised value when the construction is completed versus someone else that might not be able to go off the appraised value. They might have monthly mortgage insurance in there. The rate might be higher. There might be additional costs because there's not that much equity in the property. So you're saying that this is a niche that you're giving to all us brokers.
That's right. That's right. So it helps you. It helps us because we feel we have a bona fide appraisal, which shows us the true value of the property once completed. So we're comfortable with the risk level that we're taking on. And it helps our clients, the brokers, and it helps the consumer as well obtain better terms on their financing.
So what's ideal is anyone out there that has a construction loan and you have your pre-approval from someone that will refinance you out of that construction loan, come over to us at Topaz Mortgage. Call me directly, 301-467-8444. That number's 301-467-8444. And we'll go ahead and give you a scenario of what we can do to compete with the offer that you currently have. If we beat it, great. If not, congratulations. I mean, there's no cost to you to shop around.
Yep, and I know what you do have access to, at least through our company, Todd, is great jumbo product. And by jumbo, for those that don't know what that means, that's typically something in excess of $417,000.
Right, and I do want to get into that. But by the way, if you're just tuning in, I have with me Michael Royal, who is a wholesale investor, and he's talking about construction loans, and we're going to get into jumbo loans. Also, Jim Musgrave from Research Financial Strategies standing in to give us a little temperature check so we don't talk over everyone's head with the jargons that we know. And I'm your host, Tyler Borowitz. You're listening to Salem Broadcast Network, WRC 1260 AM. Now, Michael, you're talking about jumbo loans, and this whole area is jumbo loans.
It really is. When you get close into D.C., whether it's in the Virginia side or the Maryland side, really anything in excess of $417,000, some lenders will consider jumbo. Of course, and I'm sure you've talked a bit about Fannie Mae and Freddie Mac.
Right. Well, the super conforming goes up to $625.
That's right.
And are you talking about your super jumbos, or are you talking about your super conforming?
I'm talking about the jumbos beyond that, beyond the $625.
Okay. Temperature check, Jim.
Okay, Todd, what is a super conforming and what is a jumbo loan, or is a super conforming a type of jumbo loan?
All right, there's three types of categories. You have a loan up to $417,000. It's considered conventional. That's your traditional. Before 2008, anything over would be considered like a jumbo loan. So what Fannie Mae, Freddie Mac, because it's owned by the government, they determined that it's called super conforming. So loan amounts from $417,000 to $625,000 is considered super conforming. So we basically can do the refinances for all the people in that category.
Right, okay.
Now, it might be a little higher rate, it might be a little bit more cost, but it still fits that category and people can refinance. Anything over $625,000 is considered a true super jumbo.
Okay.
And that's what Mike's talking about today.
So the super conforming is just almost in that donut hole between $417,000 and $625,000.
Right. And the people that did those subprime loans and they should have done like a 30-year fix, and they
Yeah.
qualified for a 30-year fix, but people dumped them in a 2-1 arm, or all these problems we had with our economy.
Right.
Someone that has a true super jumbo loan over 625, they most likely like took a 10-year interest only. They took a 7-1 arm. They took an arm because interest rates before 2008 were considered too high to take a 30-year fix on a super jumbo loan.
Right.
So all of these 10-1 arms interest only are starting to mature, and people have no place to go. Some people are upside down on their property.
Right.
Some people can't get help from anybody, and these lenders are starting to pop up a little bit saying, hey, we got something to help you. And that's what Mike is here to talk about.
That's right. And we have very competitive pricing that you have access to, Todd, on our 30-year fixed jumbo, as well as our ARM options on our portfolio jumbo.
And they're very aggressive because at Topaz Mortgage, our motto is to let me do your loan scenario. I'll give you my exact closing cost, my best rate, and then I invite you to shop around with other investors. All right. Now, Mike, let's tell our listeners about we're talking about different loan limits. Every area is a little different. Washington, D.C. is different than Howard County and so forth. Right.
We did talk about the thresholds at 417 and the 625. Now, that 417 is a threshold nationally. In the D.C. area, we've got that super conforming capping out at 625. When we go up closer to the Baltimore area to include Howard County, Anne Arundel, Baltimore County, Baltimore City, you'd get into the jumbos above 494,000. So that number that relates to the super conforming is lower in the Baltimore area. So if you have listeners out there that need jumbo financing, they're going to need it sooner in the Baltimore area in terms of loan amount than they would in D.C.
Right. And these investors are currently coming out with these products. So people that have adjustables right now, you need to do something, and the lenders are basically coming forward at this time.
Right. And we actually see, you talked a little bit about folks with adjustable rate mortgages. We're seeing a lot of refinance activity for folks that may be, 4 years into a 5-year ARM, and they're rolling back into another 5 or 7 or 10-year ARM, which I know is something that you can help them do.
Right. And it's interesting because about 4 years ago or 5 years ago, the 30-year fix blew away the adjustables, and those that could get in, it's great, but there was a lot of people that couldn't get in there.
That's right. There was a time when it made very little sense to take an ARM, right? Because the spread between the ARM interest rate and the 30-year fixed rate was so narrow, who would do it? Now we have the spreads so that it makes some sense to consider a 5 or a 7 or a 10-year ARM because the savings on the interest rate and the payment are substantial.
Okay. So tell me about your hot product.
We call it our portfolio ARM. And it's in the form of either a 5, 7, or a 10-year. We do look for very clean credit in terms of the credit score, some equity in the property, and relatively stable debt-to-income ratio. So something that's not extraordinary. Okay. But it's pretty flexible in the sense that one of the things I'm finding out there is that some of our competitors, even if you're doing a loan on a primary residence, they don't want the borrower to have more than 4 properties financed on a jumbo. If it's on our ARM product, we don't care. We're indifferent to how many properties the borrower has.
Okay. So your niche is a portfolio, and what he means by portfolio is they don't follow what the rules of qualified mortgage is. They basically say, we make the rules, this is what we're willing to do, and if you fit, great. We're not going to let anyone else tell us what to do. Would you say that's...
I think that's an accurate description.
Now, as far as our listeners, I'm sure people like Jim who do wealth management, portfolio is basically, it's just controlled by the investor. It's not that you have a book of like houses. It's a totally different meaning of word for portfolio. Well, Michael and Jim, thank you so much for talking about our construction loans. Coming up next, we have Hank Dearden, Senior Director of Operations for Trees for the Future. We'll be right back after these messages.